Welcome to Wall Street Week, the show that analyzes the week that was and helps position you for the week ahead. I'm Maria Bartiromo. Coming up, legendary life strategist and entrepreneur Tony Robbins will join us in just a bit on Wall Street Week. But first, it was a busy week from Main Street to K Street to Wall Street. The big event was the jobs number on Friday. The U.S. economy added 235,000 new jobs in the month of February. The unemployment rate ticked down to 4.7%. The jobs report is key for Wall Street as it looks for confirmation that the Federal Reserve will raise interest rates next Wednesday when the Fed meets. The Fed funds futures expecting a nearly 90% chance of an interest rate hike at that meeting. That jobs report sparking a market rally on Friday, but it was not enough to put the Dow in the green for the entire week. The industrials snapping a 4-week winning streak. Other big headlines this week moving the markets. The Republicans rolled out their plan to replace Obamacare. The bill facing tough criticism from conservatives who say that the tax credits are just subsidies by another name. It does, however, eliminate most taxes from Obamacare, especially the ones targeting investors. The White House and House Speaker Paul Ryan pushing for repeal and replace by April. Meanwhile, on Wall Street, Snap's first full week of trading was not a good one. Snap falling to a post-IPO low. Investors weary of the company's growth potential. To overseas we go. The European Central Bank leaving its interest rates and quantitative easing program unchanged. ECB President Mario Draghi, however, did stress that election results in some of the EU's biggest economies like France and Germany could cloud that outlook. Markets rallied on that press conference. To our market pros right now, NewOak Capital co-founder and president Jim Frischling is with us, along with Bank of America's Global Wealth and Investment Management Division Chief Investment Officer Chris Hyzy. Good to see you both. Thank you so much for joining us.
Thank you.
So let's look back and look ahead. Obviously, the big event for the week was the jobs number out on Friday. The jobs numbers were better than expected. How would you characterize it, Chris?
I would characterize it as, I think Goldilocks' cousin has just showed up. When you think about where we've been and where we're headed, we're in that next late cycle phase now where the Fed actually is going to have to start getting going, and looks like the March meeting is not only live, it's almost assured that they will move. It puts into question, is it 3 times this year or is it 4 times? And as long as they continue to inch and be measured about it, and we see good inflation come in, which is what we're seeing right now, plus the fact that nominal growth is rising, and you get this profit cycle continuously moving ahead, the jobs number on Friday is telling us that small business jobs are growing, and that is the key to the economy.
Yeah, and small cap stocks did not perform well this past week. Any correlation?
I think they got a little ahead of themselves last year, and it's a little bit of a pause right now. Some of the passive flow of money coming into the bigger ETFs is forcing it right into the larger cap arena. And I think from this point forward, going for the rest of the year, the small cap is the area of the U.S. market that we should focus on.
All right, so you want to buy small caps then?
That's right.
All right, Jim, let me turn to you. With a portfolio, $500 million portfolio where you're largely fixed income, an increase in interest rates is going to have an impact, no?
It's absolutely going to have an impact, and I think the jobs number we just talked about is the certainty that the Fed is going to make their move next week. And I actually think it almost signals the Fed is probably behind the curve. I think we're going to see a series of increases, and I think there's going to be a lot of pressure. First of all, on some bond portfolios. I'm not as enthusiastic about certain elements of the stock market. I do think we're in the late innings, but in fixed income, I do think we're going to see an aggressive move by the Fed, and the market's going to have to get used to this right now and react to it. And I think the market might be surprised at how aggressive the Fed actually moves.
You make a good point, because if we see the Federal Reserve raise interest rates next week, that immediately launches new expectations of more rate hikes to come. We're talking about 3 rate hikes in 2017 or 4 rate hikes. What do you think?
I don't think anyone should underestimate the impact that the monetary policies have had on this plus 8-year bull run. I'm a believer that we're in the late innings of this run, and whether we have another year to stretch out or a little more, I think the monetary policy is going to shift, and I think that's going to become from a tailwind to a headwind to markets. What's replacing that now is the fiscal stimulus and what President Trump is going to be doing. But again, he's not going to have the same favorable backdrop that the markets are not going to have that favorable backdrop that we've had for almost the last 8 years.
I think you'll want to really key in on this, because that's what's been sending these markets higher, right, Chris? This idea that we're getting new fiscal policy out of Washington, tax cuts, a rollback in regulation that is going to really spur economic growth. How how important is the timeline? For example, if we don't see tax reform happen by August of this year, are we looking at a major sell-off in stocks?
Well, the thing is you've hit it on the head, which is you know, what is it? Do we get tax reform by August, like the Secretary of Treasury said, or at least the framework of it? I think you look at it in three ways. The first movement of this rally, going back before the administration's move coming in, or at least winning in November, was profits. We hadn't had profits for 5 or 6 quarters. We were negative or zero. Then we started to get some profits, a cyclical value move, global synchronized recovery, and then animal spirits take over about fiscal stimulus, whether it's tax reform and infrastructure package. We need to see action before this year closes to seal that back half of that performance that we've seen since January.
Yeah, but I mean, there's a bid under this market now.
Right.
If we don't see these policies materialize, that bid goes away?
You can have it fade, for sure. Profits are still going to go forward. And we can't dismiss the fact that the profit cycle is in its sweet spot right now, and we're starting to track close to double-digit growth without fiscal stimulus.
Gentlemen, great to see you both.
Thank you.